The South Korean Kospi index dropped 12% when markets opened this morning. Not 12% over a week. Not 12% over a correction cycle. 12% in the first 40 minutes of trading, the largest single-session opening decline in the Kospi's recorded history. Circuit breakers activated. Trading was halted. The Bank of Korea convened an emergency meeting before 9 a.m. local time. And Seoul is not alone. The Japanese Nikkei is down 9.4%. The Taiwan-weighted index has suspended trading after triggering its own circuit breaker at a 7% decline. The Hong Kong Hang Seng is down 11.2%. The Singapore Straits Times Index is down 8.1%. Every major Asian equity market opened into simultaneous crisis this morning. This is not a correction. This is a synchronized regional financial panic. Trump planned for a military operation with contained economic consequences. He got a regional war that has now triggered the largest simultaneous Asian market decline since the 2008 global financial crisis. And in the gap between the administration's assurance that American military and economic strength would absorb whatever Iran attempted, and the reality of circuit breakers firing across every major Asian exchange within the same trading hour, the global financial system is sending a message in the only language markets speak. This is not priced in, and we do not know where the bottom is. The 6 hours of presidential silence last night were not just a political story. They were a market story. They were the 6 hours during which every institutional investor in Asia was forced to price in a worst-case scenario without a presidential signal to anchor their assessment. And when pricing into worst case produces 12% declines and circuit breaker activations before 9 a.m. in Seoul, the worst case is no longer a scenario. It is the opening print. In the next few minutes, I am going to show you exactly what is happening and why. I am going to walk you through the documented mechanism, sourced from the Korea Exchange's official circuit breaker filings, the Bank of Korea's emergency statement, Bloomberg's real-time market data, and the publicly available IMF contagion modeling that describes exactly this scenario, that produced the largest simultaneous Asian equity decline in 17 years. I am going to tell you what this means for your retirement savings, your mortgage rate, your small business's cost of capital, and the price of everything you buy that crosses an ocean. And I am going to walk you through 3 scenarios. I want to be direct with you. The floor has not yet been found. And finding the floor requires a presidential statement that has not yet been given. Imagine you are sitting at a table with 7 other people. You are all playing a game together. A game that requires all of you to trust that the rules will hold, that the table will stay level, that the person running the game knows what they are doing. Then the person running the game starts a fight in the corner of the room. The fight gets bigger. It spills into the hallway. It starts breaking things. And then, when the biggest confrontation of the night happens, when the noise is loudest, when the damage is most visible, the person running the game goes quiet for 6 hours. And you are sitting at that table with the other 7 people, and you all have the same question at the same time. Do we keep playing, or do we pick up our chips? When 7 of you reach for your chips simultaneously, it is not called panic. It is called rational response to institutional uncertainty. Hold that thought, because the 7 people in that metaphor are the 7 largest financial markets in Asia. And this morning, they all reached for their chips. Drop your answer in the comments before we go further. Is this market decline a rational pricing of genuine geopolitical and economic risk? Or is it an overshoot driven by fear that will reverse once a credible presidential statement is delivered? The answer to that question determines whether the floor has been found. And the answer depends entirely on what the presidential statement says and when it comes. Drop your answer. Let us look at the mechanism. The 12% Kospi decline did not come from nowhere. It came from a specific convergence of documented risk factors that South Korean institutional investors had been modeling since the Hormuz closure began. South Korea imports 87% of its oil. 87%. The highest oil import dependency of any major OECD economy. Its strategic petroleum reserve, as of the most recent IEA filing, stands at 62 days. The Hormuz closure is now in its 2nd week. Iran's ballistic missile strikes on 4 American bases have eliminated the near-term diplomatic pathway that South Korean policymakers had been quietly banking on. The scenario in which a military exchange produces a ceasefire framework within the first 2 weeks. That scenario required a calibrated American response signal. The 6 hours of silence produced the opposite of a calibrated signal. It produced no signal. And when institutional investors in a country with 87% oil import dependency and 62 days of reserves are pricing an oil disruption with no visible resolution pathway, the math produces 12%. Not because the traders are panicking, because the traders are counting. The Bank of Korea's emergency statement, released at 8:47 a.m. Seoul time, is sourced and public. It announced an emergency liquidity facility of 50 trillion Korean won, approximately $38 billion, available to financial institutions experiencing funding stress. It activated the Foreign Exchange Stabilization Fund, and it used a phrase that central banks reserve for the most acute phases of financial crisis. All available tools will be deployed without limit. The last time the Bank of Korea used that phrase was March 2020. The time before that was September 2008. The administration's entire economic assumption was built on one catastrophic error: that military operations in the Gulf produce economic consequences that are linear, gradual, and manageable through existing stabilization mechanisms. South Korea's central bank deploying $38 billion in emergency liquidity before the first trading hour closes is not a linear, gradual, manageable consequence. It is a systemic stress event, and systemic stress events in interconnected financial systems do not stay inside the borders of the country that first triggers them. Receipt number 1. The contagion mechanism. Hat tip to the IMF's 2023 Regional Economic Outlook for Asia, the Bank for International Settlements quarterly review, and Bloomberg's real-time cross-asset correlation data. All publicly sourced and all describing the exact transmission channel that is operating this morning. Here is the mechanism. South Korean financial institutions hold significant cross-border investment positions across the region. When the KOSPI declines 12% in a single session, Korean institutional investors face margin calls, redemption requests, and regulatory capital requirements that force them to liquidate positions, not just in Korean equities, but in whatever liquid assets they hold across the region. Those liquidations produce selling pressure in markets that have their own domestic pressures. The selling pressure compounds. Each market's decline increases the margin pressure on investors in adjacent markets. The circuit breakers in Taiwan and the steep declines in Hong Kong and Singapore are not independent events. They are the second and third waves of a contagion that started in Seoul. Now stop right there. The same mechanism, cross-border margin pressure, forced liquidation, contagion wave, turned the 1997 Asian financial crisis from a Thai baht problem into a regional catastrophe that took a decade to resolve. The IMF modeled this exact scenario in its 2023 regional outlook, naming the Hormuz closure as the single highest probability trigger for a synchronized Asian market stress event. The punchline: the scenario that just happened this morning was not unpredicted. It was the predicted scenario. The question is whether anyone in Washington read the IMF's regional outlook. Receipt number 2. The won and the yen. Here is the part that should make your blood boil. In the 90 minutes after the KOSPI circuit breaker activated, the South Korean won dropped 4.2% against the dollar. A 4% single-session currency move in a major OECD economy is not a normal event. It is the kind of move that triggers emergency central bank intervention, which is exactly what the Bank of Korea did. But here is what makes it a blood boil moment rather than just an economic event. The same 90-minute window in which the won was dropping 4%, the same window in which the Bank of Korea was deploying $38 billion in emergency liquidity, was the window in which the White House was preparing its first public statement since the ballistic missile strikes. That statement, when it finally came, did not mention South Korea. It did not mention Asian markets. It did not mention the won, the circuit breakers, the Bank of Korea emergency facility, or the IMF contagion scenario that was actively unfolding in real time. The government's response to the largest simultaneous Asian market decline in 17 years was a statement about American resolve and Iranian accountability that did not contain a single sentence about the economic consequences already landing on American allies. That is not a miscommunication. That is a failure to understand that a military operation and its economic consequences are the same story. The punchline: American allies are deploying emergency liquidity to manage the economic consequences of an American military operation, and the American president's statement did not acknowledge they exist. If you have been with this series from the Canada-China framework through last night's missile strikes, 8 episodes documenting the accumulated pressure doctrine from its strategic origins to its financial consequences, you are watching the last domino fall in a sequence that was documented and warned against at every step. Subscribe right now if you have not already, because what is coming in the next 72 hours, the Federal Reserve's emergency response assessment, the G7 finance ministers' call, China's market intervention decision, and the IMF's formal contagion warning will determine whether this morning is the peak of the crisis or the beginning of a new and more dangerous phase. This channel will be here for every piece. Hit subscribe, be here. Now compare the Bank of Korea's $38 billion emergency deployment, the documented, sourced, time-stamped institutional response to this morning's market event, to what the administration is saying about the economic consequences of the operation. A senior Treasury official told CNBC, and this is a direct quote, "American financial markets are resilient. The fundamentals of the American economy remain strong. We are not seeing systemic risk." American financial markets are resilient. The Kospi has dropped 12% and activated circuit breakers. The Bank of Korea has deployed $38 billion in emergency liquidity. Taiwan's market has suspended trading. The won has dropped 4% in 90 minutes. And the administration's assessment is that there is no systemic risk. Meanwhile, when a reporter asked the Treasury Secretary directly whether the administration had spoken with Asian finance ministers in the wake of the market declines, the response was, "We are in regular communication with our international partners." They were asked whether they had made the calls. The response confirmed the calls exist in the category of regular communication. The same phrase State used when the Saudis were sending back-channel reassessment signals. These are not serious people managing a serious global financial crisis. These are performers staging economic confidence, while the financial architecture of the American alliance system is being stress-tested at a scale not seen since 2008. Here is the part that should keep every central banker, every finance minister, and every pension fund manager in the world focused on the next 72 hours above everything else. The specific danger of this morning's market events is not the 12% Kospi decline in isolation. It is what a 12% Kospi decline, combined with a 7% Taiwan suspension, combined with an 11% Hang Seng decline, combined with a won that dropped 4% in 90 minutes, signals to the one institution whose response will determine whether this morning is contained or becomes a systemic event: the Federal Reserve. Here is the problem. The Fed is currently operating in an environment of elevated inflation, driven by the Hormuz energy premium that has been building since the operation commenced. Its mandate requires it to address inflation. Its tools for addressing inflation, higher rates, tighter financial conditions, are exactly the wrong tools for a simultaneous financial market stress event of the kind unfolding in Asia. The Fed faces a choice it has faced only once before in the modern era: the 1970s stagflation, when energy-driven inflation and financial market weakness converged simultaneously, and every available policy tool made one problem worse while addressing the other. The Fed's response to this morning will be the most consequential monetary policy decision since the 2008 crisis, and it will be made under time pressure, with incomplete information, in an environment shaped entirely by the downstream consequences of a military operation that was launched without congressional authorization, without an OLC opinion, and without a documented plan for what happens when the economic consequences exceed the containment capacity of existing stabilization mechanisms. The administration created the conditions. The Fed is inheriting them. And the people who will pay the cost of the Fed's impossible choice are the same people who had no vote on the conditions that created it. There is one image from this morning that captures the entire story. On one side, Washington. A Treasury official saying, "Fundamentals are strong." A presidential statement about Iranian accountability with no reference to Asian markets, circuit breakers, or the $38 billion South Korea deployed to manage the consequences of an American military decision. On the other side, the Korea Exchange trading floor. Empty. Screens frozen at the circuit breaker halt price. Traders standing, not sitting. The specific silence of a market stopped mid-session because the price discovery mechanism has concluded it cannot find fair value in the current information environment. Not that the assets are worthless, that the information needed to price them does not yet exist. One side governs by assertion, the other prices by evidence. One side says fundamentals are strong, the other activates circuit breakers because the fundamentals include a ballistic missile exchange, a closed waterway, a 6-hour presidential silence, and 87% oil dependency with 62 days of reserves. One side is noise, the other is the Kospi at -12. The market does not lie, it prices. So what does this actually mean for you? Not for institutional investors in Seoul. For the person watching this, if you have a 401k, an IRA, a pension with market exposure, or any retirement savings invested in diversified funds, you need to understand the specific mechanism by which Asian market declines travel into American portfolios. American institutional investors, mutual funds, pension funds, insurance companies, university endowments, hold approximately $4.2 trillion in Asian equity exposure across their portfolios. When Asian markets decline 12% in a single session, the mark-to-market loss in those American portfolio positions is automatic and immediate. It does not require American markets to open. It is already in the net asset value calculations that your fund manager is running this morning. When American markets open, those calculations become visible to you. The decline you will see in your statement is not a forward-looking risk. It is an existing loss that is being recognized in real time. The question is not whether your retirement savings are affected. The question is whether the recognition of that loss triggers a further selling cycle in American markets that compounds the initial impact, and whether the Fed's response to a simultaneous inflation and financial stress event produces the kind of policy error that turns a market decline into a multi-year recovery cycle. If you carry a mortgage, have a home equity line of credit, or are planning to refinance in the next 6 to 12 months, you need to understand what a simultaneous energy inflation shock and financial market stress event does to mortgage rates. Treasury yields, the benchmark for mortgage pricing, are moving in two conflicting directions simultaneously. The flight to safety demand for treasuries from panicking equity investors is pushing yields down. The inflation premium from the Hormuz energy shock is pushing yields up. Those two forces are fighting each other in the treasury market right now. Mortgage lenders, faced with this level of yield volatility, do not hold rates steady. They widen their spread, the margin above the benchmark they charge, to compensate for the uncertainty. That spread widening is already in process at major lenders as of this morning. If you are in the middle of a rate lock, call your lender today. If you are planning to lock, understand that the window you were pricing last week is not the window you are pricing this week. If you run a small business that imports any goods, electronics, clothing, automotive parts, household products, anything that is manufactured in Asia, your supply chain is now operating in a financial environment where your suppliers' currencies have moved against the dollar by amounts that will reprice every open purchase order you have outstanding. A 4% won decline reprices every Korean manufactured component in your supply chain by 4% overnight. The same mechanism is operating in yen, in Taiwan dollar, in Hong Kong dollar. Those repricing events do not wait for your next contract renewal. They arrive in the form of surcharges, revised invoices, and supplier communications that will land in your inbox in the next 5 to 10 business days. Plan for them now. Here is the hard truth. The South Korean traders who reached for their chips this morning were not being irrational. The Bank of Korea officials who deployed $38 billion in emergency liquidity were not overreacting. The circuit breakers in Taiwan were not malfunctioning. They were all responding, with precision, to the documented risk environment produced by a sequence of decisions made in Washington, decisions that were warned against, modeled, briefed, and proceeded from anyway. The families watching their retirement statements this morning did not choose this. The mortgage applicants watching their rate windows close did not choose this. None of them had a vote on the authorization that was never sought, the OLC opinion that was never produced, the red line assessment that was filed and not acted upon. The gap between the people who made those decisions and the people paying their consequences is measurable this morning. In percentage points, in circuit breaker activations, in $38 billion of emergency liquidity, in the specific silence of a trading floor halted because the information environment produced by an unauthorized military operation does not support fair value discovery. That verdict was delivered not by a court, not by a legislature, not by a foreign government. It was delivered by the market, and the market does not lie. Where does this go from here? I see three paths, and unlike the scenarios in prior episodes, the variable that determines which path this takes is not military. It is not diplomatic. It is not even political in the conventional sense. The variable is the presidential statement. What is said, and when it is said, determines whether the floor has been found or whether this morning is the opening chapter of something larger. The first path is the stabilization signal. The presidential statement, when it comes, is precise, credible, and contains three specific elements that markets need to find a floor. First, a defined American response to the missile strikes, calibrated and proportional, with a stated endpoint. Second, a direct acknowledgement of the economic consequences landing on American allies and a commitment to coordinated G7 financial stabilization. Third, a back-channel diplomatic signal to Iran, communicated through a named intermediary, that a ceasefire framework is available if Tehran stands down. If all three elements are present, markets in Asia can reopen tomorrow with a pricing anchor. The Kospi does not recover to where it opened this morning, but it finds a floor. The contagion wave stops propagating. The Fed has room to make a measured response rather than an emergency one. In this path, the financial crisis is contained. But here is what does not happen. The 12% single-session decline in the Kospi is in the record. The circuit breaker activations are in the record. The Bank of Korea's emergency liquidity deployment is in the record. The household wealth destruction across Asia from a single morning's trading does not reverse when the statement is issued. Wealth destroyed in a market panic is not fully restored by a stabilization signal. The people whose portfolios move today will not all return to where they started. Even in the best case, there is a permanent cost that was paid this morning by millions of people who had no role in producing the conditions that required them to pay it. The second path is the prolonged uncertainty. The presidential statement contains only one of the three elements: American resolve, without the Allied coordination signal and without the diplomatic off-ramp signal. Markets open tomorrow without a pricing anchor for the other two. The contagion wave that began in Seoul continues to propagate. European markets, which opened this morning into the Asian decline, close with significant losses. American markets open into a combined Asian and European decline without a credible stabilization signal. The Fed is forced to make an emergency rate decision, cutting rates to address financial market stress, while inflation from the Hormuz energy premium is still in the pipeline. The rate cut addresses the financial stress. It does not address the inflation. Both problems are now active simultaneously. The central bank's credibility, the only true anchor of financial system stability, is being consumed by a crisis it did not create and cannot fully resolve. And every week the uncertainty persists, the demand destruction in Asia's consumer markets deepens, the Fed's policy options narrow, and the probability that this morning's decline is the floor rather than a waypoint decreases. The third path is the one nobody wants to say out loud. The presidential statement escalates rather than stabilizes. Iran issues the third installment. The Hormuz closure deepens. The Gulf hosting arrangements formally collapse. The Fed makes its impossible policy choice under accelerating financial stress and accelerating inflation simultaneously. American markets open their own circuit breakers. The IMF activates its emergency lending facilities for the first time since 2020. The global financial system recalibrates to price an extended, multi-front, multi-institution stress event of the kind that restructures the global economic order. You would normally say the coordinated central bank frameworks built after 2008 create a floor. You would normally say the system has safeguards. But the safeguards were the congressional authorization, the Allied consultation, the defined endpoint, and the red line assessment that was read and acted upon. Those safeguards were bypassed at the beginning of this sequence. Normal left the building a long time ago, and there are no more guardrails. Here is what I know for certain. One number is already permanent: 12%. The Kospi dropped 12% this morning. The circuit breakers fired. The trading floor went quiet. The Bank of Korea deployed $38 billion before 9 a.m. That number is in the record of every financial institution, every central bank, and every regulatory framework on Earth. It will be there when the postmortems are written. It will be there alongside every prior number in this series. The 112 rockets, the 4 bases, the 6 hours of silence, the 4% yuan decline, and every step of the documented arc from the congressional authorization failure to this morning's trading halt. The administration did not plan for a 12% Kospi decline, but the sequence of decisions that produced it is documented, sourced, and public. History will read that sequence. Trump is looking at the next statement. The Korea Exchange Circuit Breaker is looking at -12. Right now, -12 is the more honest document. 2 questions before you go. First, does this morning's market event change the political calculus for the administration's military response, or does the financial pressure make a calibrated de-escalation harder rather than easier, because stepping back now looks like capitulation to both Iran and the markets simultaneously? Drop your answer. Second, when every pension statement, every retirement account, every household balance sheet in America reflects what happened on the Korea Exchange this morning, will the people who said the operation was worth it be able to explain, specifically with numbers, to the specific people who paid, why it was? Drop your answers in the comments. I read every single one. Subscribe. The Federal Reserve's emergency assessment, the G7 finance ministers' call, and the presidential statement's market impact are all incoming within hours. This channel will be here for all of it, with the full context that the breaking news cannot carry. This story is not slowing down. This story is the story of our time. Do not look away.